right now, I mean, your wallet is basically sitting in the middle of this massive economic tug of war.
Yeah, a really violent one, honestly.
Exactly. On one side, you have the United States government spending so much money that the annualized interest alone on the national debt just hit $1.6 trillion.
Which is just a mind-boggling number.
Right, so they're slamming the inflationary gas pedals straight to the floor.
Mhm.
But then on the other side, you've got the tech industry, right? And they are pulling the emergency brake by engineering this hyper-deflationary force of AI and robotics.
It's basically the ultimate unstoppable force colliding with an immovable object. I mean, you have a macroeconomic structure that is just desperate to inflate its way out of debt, right? It's smashing headfirst into a technological wave that's literally designed to drive the cost of human labor and intelligence to zero.
And today, we are figuring out who actually wins that collision.
Yeah.
We're doing a deep dive into two incredibly eye-opening interviews from Anthony Pompliano's network, and they feature two completely opposed financial minds.
Right, we've got Peter Schiff and Jordi
It's
Visser.
exactly. The legendary financial commentator Peter Schiff, who breaks down the inescapable math of this inflation and debt crisis, pitted against macro investor Jordi Visser, who's laying out this deflationary shockwaves of AI.
It's a crazy contrast.
It really is. So the mission for this deep dive is to give you, the listener, a masterclass on how these two opposing forces are rewiring the global economy, the stock market, and, your own personal purchasing power.
So to start, I mean, Schiff's core thesis requires us to completely discard the mainstream narrative around inflation.
Okay, how so?
Well, you see headlines cheering a 3.5% consumer price index, right?
Right.
And politicians, they package that as a victory.
Right, like, hey, inflation is down.
Exactly. But Schiff, he looks at the unadjusted numbers and sees a totally different reality. He points specifically to import prices rising by 7.1% year over year.
Wow.
And crucially, that is before you even factor in any tariffs. Meanwhile, export prices jumped over 10%.
Okay, which means that 3.5% CPI number is, like, heavily massaged.
Oh, completely.
Because if the raw materials coming into the country are up 7% and the finished goods leaving are up 10%, I mean, the American consumer is absorbing that double-digit spread at the checkout counter, right? Regardless of what the official CPI basket claims.
Yeah, and that brings us to Schiff's redefinition of inflation itself. You know, most people view inflation merely as a symptom like, oh, prices are going up at the grocery store.
Right, eggs are more expensive.
Exactly. But Schiff argues we need to view it as the disease itself, which is the systemic expansion of the money supply and credit by the government.
Ah, okay.
He frames it as an invisible, non-legislated tax. And the mechanism of this tax becomes super obvious when you factor in technological progress.
Give me an example of that.
So let's say manufacturing efficiencies dictate that a new television should drop in price by like 3% this year.
Makes sense. TVs get cheaper to make.
Right. But the government dramatically expands the money supply, they dilute the currency, and the price of that TV actually goes up 7% instead.
Oh, wow. So the consumer didn't just lose the 7% to price hikes. They lost the 3% savings the free market would have naturally generated, plus the 7% increase.
Exactly.
So that's a 10% total loss in purchasing power.
Yeah. And that wealth doesn't just, evaporate into thin air. It gets stealthily transferred to the government to fund deficit spending.
Because they print new money to pay their bills and dilute the value of the money already sitting in your bank account to cover the spread.
Right. And it's really important to note that the sources maintain strict political neutrality here.
Yeah, because this mechanism is entirely bipartisan.
Exactly. Schiff emphasizes that the massive unprecedented spike in the M2 money supply, it was aggressively initiated back in 2020 under the Trump administration.
Right, with the Paycheck Protection Program and all those huge COVID stimulus packages.
Yeah. And then that identical strategy of multi-trillion-dollar deficit spending, it just rolled continuously into the Biden administration's policies.
So it doesn't matter who is in charge?
No, not at all. The Federal Reserve and Congress basically operate in this symbiotic loop. Congress passes the deficit spending, and then the Fed monetizes the debt by acting as the buyer of last resort for U.S. Treasuries.
They expand their balance sheet so the politicians don't have to actually balance a budget.
You got it.
But wait, if the Federal Reserve's mandate is price stability, and they're the ones enabling this dilution, the obvious question is, why don't they just replicate the 1980s playbook?
You mean Paul Volcker?
Yeah. I mean, Volcker hiked interest rates to nearly 20% to crush inflation. Why can't the current Fed just hike rates to, like, 10 or 12% and kill this dynamic today.
Well, the math simply does not allow it anymore.
Why not?
The structural difference between the 1980s and today is a $40 trillion national debt. As you mentioned at the start, at current interest rates, the annualized interest expense on that debt hit $1.6 trillion in May.
Insane.
If the Fed were to hike rates to 10%, the interest payments on the national debt would instantly consume almost the entirety of federal tax revenue.
Wait, all of it?
Almost all of it.
Right.
The government would be insolvent practically overnight.
Yeah.
And then add to that the downstream effects, right? A 10% federal funds rate means mortgage rates push into the mid-teens.
Oh, which would totally freeze the housing market.
Freeze it, obliterate commercial real estate valuations, and trigger a systemic banking crisis.
Yeah.
So the Fed is completely boxed in.
Okay, which means the monetary policy lever is essentially broken.
Pretty much.
So that leaves fiscal policy. I mean, Congress would have to actually fix the budget to stop the inflation, right?
Yeah, but based on Schiff's analysis, the structural solutions are politically impossible.
Because you either have to drastically slash spending or drastically increase revenue.
Exactly. And slashing spending on a meaningful scale requires cutting the primary drivers of the debt, which are entitlements.
Like Social Security.
Right. Schiff actually characterizes Social Security as a structural Ponzi scheme.
A Ponzi scheme. That's heavy.
Well, his logic is that there's no actual lockbox of saved capital. It relies entirely on taxing a continuously growing base of current workers to fund the obligations of current retirees.
Oh, I see. So as demographics shift and birth rates decline.
And math just collapses.
And touching Social Security is like the ultimate third rail in American politics.
Yeah, for sure.
No politician who actually wants to get reelected is ever going to suggest cutting those benefits.
Never. Which forces them into the second option, right? Raising taxes.
Okay.
But even that has a massive structural flaw when it comes to fighting inflation. You can't simply tax the ultra-wealthy to cool down an inflationary economy because billionaires primarily park their capital in assets and investments. They aren't buying, a million gallons of milk. To stop consumer price inflation, you have to stop the velocity of money.
You have to stop everyday consumption.
Exactly. And that mathematically requires heavily taxing the middle and lower classes.
Because they're the ones spending their paychecks into the real economy, buying goods and services, which drives up prices.
Right. And again, that is an absolute political non-starter.
Yeah, a platform of like, hey, we're cutting your retirement benefits and hiking your middle-class income taxes to cool the economy. I mean, that would be electoral suicide.
Total suicide. So by sheer process of elimination, the government's default setting is just to let inflation run hot.
They're highly incentivized to keep the machine running, quietly taxing you by devaluing the currency just to service that $40 trillion debt.
Exactly. But here's the twist. If the government is structurally locked into this inflationary death spiral, you would expect a total collapse in purchasing power across every single sector of the economy.
Right.
But we aren't seeing that uniformly. There is a shadow force actively pulling prices in the exact opposite direction.
And that brings us to Jordi Visser's thesis, right?
Yes.
If we can't look to the Fed for rescue, we basically have to look to Silicon Valley. Visser points to the sheer, undeniable deflationary power of artificial intelligence and robotics.
Yeah, Visser suggests we're witnessing the end of capitalism as we traditionally define it.
That's a huge statement.
It is. But think about it. Capitalism is fundamentally an economic system designed to allocate scarce resources.
Okay.
But AI and robotics are systematically driving the cost of human intelligence and physical labor down to an asymptote of zero.
So, like, practically free.
Right. Visser calls this a transition to a world of abundance. If the primary inputs of production, thinking and doing become practically free, the entire pricing model of the global economy just breaks.
But getting to that world of abundance requires an unprecedented amount of upfront investment, right?
Oh, massive amounts.
And the sources highlight this really fascinating perspective from former Google CEO Eric Schmidt. The prevailing narrative is always that the AI revolution will be bottlenecked by the energy grid-like. We literally won't have enough electricity to power the data centers.
Right. You hear that everywhere.
But Schmidt argues the actual friction point isn't energy, it's capital.
The money.
The sheer amount of money required to physically build out the compute infrastructure is just staggering.
Yeah, just look at the corporate financial statements right now. Google recently posted negative free cash flow.
Which usually terrifies Wall Street.
Exactly. Wall Street hates that.
Yeah.
But the context is everything here. Google is spending capital at such a ferocious rate to build these AI data centers that they currently have a $514 billion backlog in contracted cloud orders.
Wait, $500 billion?
A $500 billion of guaranteed future revenue just sitting on the table.
Because they physically cannot manufacture and deploy the hardware fast enough to meet the demand?
Exactly. American companies like Google, Microsoft, OpenAI, they are betting their entire corporate existence on this infrastructure race.
And because they are not just racing each other,
Right.
they're racing the Chinese government.
That's the real kicker.
Yeah, this is where the motivations of the two superpowers create this incredible friction. I mean, the U.S. companies are operating under a traditional capitalist model. They're pouring billions into AI to build the equivalent of toll roads.
Right. They want to reach artificial general intelligence, lock users into their proprietary ecosystems, and then just charge a monthly subscription or API fee to generate these massive profit margins.
Right. But compare that to China's approach with open source models like DeepSeek.
It's totally different.
DeepSeek is heavily subsidized by the Chinese government, and they operate entirely like missionaries, not capitalists. The founder has explicitly stated they do not care about consumer products, they don't care about generating revenue or even capturing market share.
Which is wild for a tech company.
Right. Their singular state-backed mandate is just to be the first entity on Earth to reach AGI.
And if a state-backed entity is willing to open source state-of-the-art intelligence for free just to win the geopolitical race, it completely vaporizes the pricing power of the American tech giants.
Because Microsoft can't charge a premium for AI software if China is just giving a comparable model away on the internet for $0.
Exactly. And this dynamic leads Visser to declare the death of the traditional corporate mode.
Okay, unpack that a bit.
So, if intelligence is commoditized and universally abundant, the proprietary advantages that have historically justified massive valuations in the S&P 500, they just evaporate overnight.
Because traditionally, a massive Fortune 500 company could rely on its scale, right? Its proprietary data analysis, its vast armies of white-collar workers to just outmaneuver any startup.
Right. But today, a team of 5 people in a garage can plug into an open-source AI model and instantly replicate the intellectual output of a multinational corporation.
Wow.
Competition is now happening at the speed of compute.
Okay, software intelligence becoming a free commodity is totally mind-bending. But, you can't eat a line of code.
Sure.
ChatGPT isn't going to make a dozen eggs cheaper at the grocery store. So this is where Visser bridges the digital deflation into the physical world. And he highlights the work of Travis Kalanick, the founder of Uber.
Right. Kalanick is operating a company now called City Storage Systems, which runs cloud kitchens.
Okay.
And what he's doing is taking the underlying architecture of the internet, the TCP/IP protocol that routes data packets, and he's applying it to the physical logistics of food and goods.
So just like when you send an email, the internet doesn't send it in a straight line, right?
Exactly.
It breaks the message down into data packets and algorithmically routes them through the cheapest, fastest physical servers in the world to reassemble on the other person's screen.
Right. And Kalanick is basically treating physical ingredients like those data packets.
It's like treating a physical burrito the exact same way a computer treats an email.
Exactly. He is building these automated delivery nodes and ghost kitchens to ruthlessly optimize the routing of physical goods. The goal is to compress real estate overhead, labor, logistics so intensely that the ultimate cost to the consumer drops below the wholesale cost of raw ingredients.
That sounds impossible.
Well, he wants to engineer a system where ordering a high-quality, fully prepared meal delivered right to your door is mathematically cheaper than taking the time and gas to drive to a grocery store to buy the raw components.
That is wild, but to achieve that level of physical deflation, you have to automate the labor.
Oh, absolutely.
Which brings us to the robotics debate. The media right now is completely obsessed with humanoid robots, right? Like the Boston Dynamics style machines that walk on 2 legs and mimic human movement.
Yeah, the ones doing backflips on YouTube.
Exactly. But Kalanick and Visser argue that relying on humanoids for supply chain efficiency is actually a massive misallocation of capital.
Yeah, because humans evolved for general purpose survival.
Yeah.
We balance on 2 legs so we can navigate uneven terrain, climb things, adapt. But if you're trying to move a 50-pound box across a totally flat warehouse floor to eliminate a logistical bottleneck, spending billions of dollars engineering a robot to balance on 2 legs while carrying a shifting payload is just absurdly inefficient.
It's so funny. Visser watches these videos of humanoid robots running marathons, and he asks the obvious question, why not just put wheels on it?
Right. Specialized robotics are the actual key to this deflationary wave.
Mm,
You don't need a robot that can, play the piano and fold your laundry.
right.
You need highly specialized, capital-efficient machines designed for hyper-specific, high-volume tasks. That localized automation is what will actually drive down the cost of physical goods and counteract the government's inflation machine.
Okay, so we have the macro picture here. The government is forced to inflate the currency, while the tech sector is forced to deflate the cost of living.
Yeah.
So how do the people actually analyzing these trends invest their own capital to survive the whiplash? Because I'm sure listeners are wondering, what do I do with my money?
Well, the portfolios of Schiff and Visser could not be more diametrically opposed.
Let's start with Schiff.
Okay, so let's look at Schiff's defensive strategy, which is heavily weighted toward the physical world. He is playing defense against currency debasement.
The crazy uncle portfolio.
Basically, yeah, he heavily favors physical gold, and he notes that it surged roughly 21% recently.
Right.
But more importantly, he watches the macro flows. Foreign central banks are aggressively buying gold right now as they attempt to de-dollarize their economies and reduce their exposure to U.S. debt.
And Schiff also advocates for income-producing land, right?
Yes.
But he isn't speculating on, like, empty residential lots in the suburbs. He is buying timber forests and high-margin blueberry farms in South America.
Very specific.
Yeah, assets that produce a physical yield regardless of what the Federal Reserve does.
Right.
He even suggests holding ammunition, operating on the logic that in a severe currency crisis, high-utility physical goods become the ultimate barter currency.
It's a very prepper mindset.
Mm.
But noticeably absent from Schiff's inflation hedge is Bitcoin.
Oh, right.
And this sparked a really heated debate with Anthony Compliano in the source material.
Because Pompliano loves Bitcoin.
Exactly.
Yeah.
Pomp points to the long-term data, citing Bitcoin's massive 60% compound annual growth rate over a decade, which fundamentally obliterates gold's performance.
But Schiff pushes back heavily on that 10-year window.
Oh, yeah, he does.
Because 10 years ago, Bitcoin was essentially a niche experiment, right? Schiff argues that if you look at just the last 5 years, Bitcoin's compound annual growth rate actually drops to around 14%.
And that 5-year window is really crucial for retail psychology. Schiff argues that because of Bitcoin's violent volatility, like routinely experiencing 70 or 80% drawdowns, the average retail investor who bought in during the recent cycles is likely underwater.
They don't have the stomach to hold through a massive crash.
Right. So they buy the top driven by FOMO, and they panic sell the bottom. Physical gold, by contrast, provides a low volatility anchor.
And this friction resulted in a literal bet between the two of them, didn't it?
Yes. 1 Bitcoin against 1 ounce of gold, tracking which asset outperforms over the next 5 years.
It's like the ultimate test of the digital versus physical store of value.
Oh,
But if we pivot from Schiff to Visser isn't hiding in gold or farmland, right?
no, not at all.
Hmm.
He is riding the AI wave, but with a highly specific methodology that he calls the 30% AI infrastructure grind.
The infrastructure grind, okay.
Yeah, Visser recognizes that the era of easy money in AI software is dead.
Oh, because of the open source stuff we talked about?
Exactly. You can't just throw venture capital at an AI wrapper startup and expect a 7x return anymore, because those open source models destroy those software modes. So he moves down the stack to the physical hardware.
He's hunting for the actual scarcity.
Right.
Because, I mean, you can copy a software algorithm in milliseconds, but you cannot copy a fabrication plant.
Exactly. So he focuses intensely on memory chips and companies like Micron. Supplying the physical compute layer for a global AI rollout requires manufacturing millions of hyper-advanced chips at scale.
Which requires rare earth materials, massive capital expenditure, highly specialized supply chains.
Yes. That physical bottleneck is where Visser sees the enduring value, insulated from the open source software wars.
And Visser tracks the crypto markets as well, but his methodology here is really fascinating.
It is.
He isn't watching the fundamentals of the technology, he's watching the regulatory environment, specifically the Clarity Act in Washington.
Right, which would establish regulatory safe harbors for financial institutions to actually custody crypto assets.
Well, unlocking all that institutional liquidity.
Exactly. But his most surprising metric is Dogecoin.
Wait, Dogecoin, the meme coin.
Yes, Dogecoin. Visser uses it as a pure liquidity thermometer.
Okay, how does that work?
Well, when you analyze a meme coin, you strip away all pretense of fundamental utility or cash flow analysis, right?
Right, there are no earnings reports for Dogecoin.
Exactly.
Yeah.
It is a gauge of pure speculative appetite. So Visser notes that when Dogecoin crosses its 20-day moving average on high volume, it signals that the everyday retail investor has officially returned to a risk-on mindset.
Oh, wow.
Yeah, it means excess liquidity has trickled all the way down to the most speculative assets in the retail market.
So wait, the smartest minds are either hoarding physical gold and blueberries or they're obsessively tracking memory chip supply chains in Dogecoin.
Pretty much.
I mean, how is an everyday investor supposed to navigate this? You are living through the most complex macroeconomic shift in a century.
It's a lot to process.
On one hand, you have a government trapped by a $40 trillion debt burden, basically required to devalue your money just to afford the interest payments. And on the other hand, a technology industry spending hundreds of billions of dollars to commoditize human intelligence and automate physical supply chains.
And navigating this requires understanding both the geopolitical motivations driving open-source AI and the unyielding math of federal deficit spending.
You essentially have to decide if you want to anchor your wealth in physical scarcity, like gold and timber, or digital infrastructure, like memory chips and compute hardware.
But, before we wrap this deep dive, Visser's research methodology actually offers a glimpse into a future that might render this entire debate completely obsolete.
Oh, tell me about that.
He uses what he calls a mosaic prompt.
A mosaic prompt. What does that mean?
So Visser doesn't just ask an AI a simple question, he architects a debate.
Okay.
He takes 5 different advanced AI models and assigns each of them a distinct, highly specialized persona.
Like role-playing.
Sort of, yeah.
Yeah.
He programs one to be a forensic accountant, another to be a hardware supply chain expert, a third to be a macroeconomist, and so on.
Right.
And then he feeds them all the identical set of global financial data and forces them to analyze the information and debate each other.
Just to identify hidden market signals that a single human analyst would miss.
Exactly.
Wow. He is basically spinning up an autonomous board of super forecasters right on his laptop, running 24/7.
Yeah. And if individual investors can leverage AI agents to analyze macro trends with that level of sophistication, it raises a profound question about the future of finance.
Like what?
Like, how long will it be until you aren't the one agonizing over whether to allocate your paycheck into gold, Bitcoin, or infrastructure stocks?
Oh, man. What happens to Wall Street and the entire wealth management industry when every single retail investor has a personal AI agent continuously analyzing global liquidity, open source AI developments, and central bank policies?
And just automatically routing your savings into the optimal asset class second by second.
Completely bypassing traditional financial advisors.
Exactly.
That is wild to think about. We might not be the ones managing our own money through this tug of war for much longer.
We probably won't be.
So keep questioning the adjusted number you see in the headlines, pay close attention to those hardware bottlenecks, and we will catch you next time on The Deep Dive.